Trading price action trends. Technical analysis of price charts bar by bar for the serious trader. Chapter 1. The spectrum of price action, extreme trends to extreme trading ranges. Charts go from trending to trading ranges and back to trending. This sums up what the chart can be doing at any given time. Trends have little to no overlap. They are trading 1 to 2 ticks higher or lower than the previous bar. Ranges have overlap and often reverse 1 to 2 ticks from the prior bar. If you're unsure what the market is doing, trends leave traders with a sense of urgency, while ranges leave traders with a sense of confusion. Trends on lower time frames can be trading ranges on higher time frames. Trading ranges on higher time frames can be trend on lower time frames. The market has inertia. This means it will continue to do what it's been doing. In trends, most reversals fail. In trading ranges, most breakouts fail. So here, we have a bull trend. Bears are getting trapped, so they're buying back shorts. Every bear bar you see on the EMA ended up being a trap. If bears weren't shorting the highs, they were getting trapped. This creates a sense of urgency because bulls want to buy and bears are buying back their shorts. So both bulls and bears are buying the EMA. Two types of traders doing the same thing creates a sense of urgency and the market starts trending. Newer traders will end up buying highs, not realizing that there will be a pullback eventually. Here's an example of a range and how it can confuse traders. These bars all look good for shorts, and they were, but you had to scalp out and it had deep pullbacks. Here, the market failed to break out lower and higher. This looks like the start of a bull trend. It's a wedge bottom breakout. Let's get long for a test higher. But it reverses. Here, just as the breakout below the EMA starts to get going with a leg 2, it reverses. The market gaps down and trades below the low of the day. It ultimately reverses, trapping bears into a bad short. They buy back their shorts, and now there's a bull channel. The bull channel doesn't make a new high. It closes the gap and reverses, trapping traders into thinking this is a strong breakout after a failed bear breakout. After 2 failed breakouts, the market went to a TTR, a tight trading range. I actually got chopped up. I remember this. This is where traders need to avoid. Here, we see a strong breakout. But is it strong? Because look at the follow through at the recent swing high. It reverses, trapping bulls into the EMA. Bears think this is a good breakout. They get trapped. Bulls buy back. They hit out of their original long. Bears short again, creating another leg lower that ultimately reverses. The market sells off into the low, stalls, goes for a breakout, but gaps up and goes back into the range. So it's just a bunch of failed breakouts all the way around. And this is what traps traders, because previously in trends, this is what would make money, buying here, selling here. So it's the exact opposite of a trend. So here's an example of the lower time frames and the higher time frames. This is the 1 minute chart. This is the 5 minute chart. This box is this box. On the 1 minute, here we have a leg lower, a wedge top, and a sell. This is a breakout that led to another leg lower and a double bottom. On the 5 minute, we can see this 2-legged pullback right here. However, the bar was climactic and you would be shorting low on the 5 minute. This gives the appearance that it's a range on the 5 minute and we have trends on the 1 minute. This pullback right here is a higher low on the 1 minute here and here. It's a higher low on both charts. So we have a breakout and a pullback with a leg 2. But look at the leg 2 on the 5 minute. It's just one big bull candle. That's a buy vacuum, testing the prior swing right here. So this technically is tradable because it looks easier. However, trading the 1 minute time frame is harder, and it's better to just learn how to read this price action and wait for the breakout, which led to the easier trades here. You can get long on these flags, the pullback, long, or the second breakout. A very common setup is a leg 2 move. There's lots of different names for them. Some people refer to them as A, B, C, D. The name isn't important. However, I'll refer to legs as 1, 2, 3, 4, not A, B, C, D. For that reason, I'll be explaining and counting with legs 1, 2, 3, 4. Leg 2 moves are common because they show the side has already moved in one direction. Eager traders are wanting to get in for a second leg. Leg 3s and 4s are usually found in strong trends. Two-leg moves can come in the form of with trend trades or pullbacks into the EMA. So here's an example of some bullish two legs. We have a gap up with follow through and we're breaking out above this range. This is the strong pull and this bar breaks this low, so it's the first pullback. This first pullback is followed by a strong bar. You can buy this bar or buy this bar, but the measured move is met. Leg 1, pullback. So I start the move from here and then I project it up to here. Within this bull trend, there is a bearish leg 2 move that ended up being a pullback into the EMA. Here's the top of the bear leg to the bottom, top of the pullback, and the bears met their target and it reversed. Here's another two-legged move, leg 1, pullback, leg 2, but it's small, so I didn't want to show it. Here's a strong spike that got a pullback and a leg 2 move, leg 1, pullback, leg 2. Here's another version of a leg 2 move in the form of a pullback, leg 1, pullback, leg 2. Leg 2 moves happen all the time. In trends, they can be symmetrical, and in trading ranges, they're usually asymmetrical. Here's a bearish example of two legs. Bears get the breakout and a pullback. That's when I start the move. The target was met here with this strong bar. Within this trade, there was another two-legged pullback. There's a breakout below this range, a pullback, and that was met with this bar. After the bears have trended for a while, bulls finally got a two-legged pullback into the EMA. Leg 1, pullback, leg 2. This pullback was very deep because it's coming after a bear channel. Now that the bulls have made money, the market went more sideways because bulls are interested in buying lows. There's leg counting within ranges, but they come in different forms. So here's a leg 1, pullback, leg 2 for the bulls into the EMA. This leg was bigger than the second leg. Here's a leg 1, pullback, leg 2 for the bears into the low of this range. So within trading ranges, leg 1 and leg 2 moves sometimes can be asymmetrical. Also, leg 2's, if you bought the high of this, you would get trapped. If you short the low of this, you would get trapped. So it's important to understand when to short a leg 2 move. When to short a leg 1 looking for a leg 2, and when it's a trap. This is the end of chapter 1. Please leave any questions in the comments and I will try my best to answer them. Thank you for your time, and if you learned anything, please consider subscribing.